Good afternoon, everybody. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services. And we didn't forget about you. We're back. We took a 2-week hiatus, but we are ready to give you all the news that's fit to hear on the market for this week during this week's weekly wrap-up. So, Graham, what can you tell us?
Yeah, well, I think a pretty dramatic turnaround last week in the market, and I'll comment a little bit that went on through this weekend, and then it seems like it's carrying over as we're filming today into the next week. But really saw a reversal. You know, we really had some really strong gains into the market coming into last week, maybe 6, 7, 9%, depending on the indices. So it really rallied back from some January or April low points. And we really saw a pretty sizable pullback last week, and it looked like, it's continuing to carry forward. Last week, we saw the respective indexes, the S&P, say the Russell, all the way to the Dow, down anywhere from 4 to 5%. We saw the NASDAQ, tech-laden NASDAQ, down a bit more, about 5.5%. So again, it seems to be the turmoil in the tech area, that high growth area, is still rolling through, and it's picking up steam, and it's dragging the rest of the market right now down with it. You know, one thing that was kind of front of mind last week, and I don't think it's really left our minds, but it just got put back in our face a bit, is high inflation. You know, I think the anticipation was when we saw the CPI numbers getting ready to come out, that maybe we're seeing a plateau with inflation, and maybe it's rolling over a little bit. But at least those numbers didn't indicate that. I do want our viewers and our listeners to realize that these numbers are in the past. So inflation came out at 8.6%, so that's a higher reading. But again, keep in mind that that's in the past. So we could be in the middle of, and I'm not saying we are, we could be, we'll just have to see, but we could be seeing inflation plateauing and starting to roll over in certain areas. I think I've mentioned before the used car market. I think we're also seeing jobless claims increase. So that can help that side. Maybe supply chains issues loosen up. International markets like China opening back up from its COVID shutdowns. You know, some of that thing, which will be in these numbers going forward, might show maybe inflation plateauing or coming down. Again, we'll just have to see with that.
Well, Graham, you know, there's been a lot of chatter about a recession. What can you speak to that?
Well, you know, I hate to think about recessions. No one wants to go through it. And I know I'm telling everyone something that you're feeling. I know it's nerve-wracking. It's scary. You know, I know many of us, our minds go back to 2008, 9, when we saw the markets down 57 odd %. But let's keep in mind, the odds of a recession, yeah, they've increased. The odds of us going into recession are probably pretty high. Does it need to be a deep, protracted recession? Not necessarily. You know, recessions are relatively common. You know, happen, every 5 to 10 years, along with bear markets. That's 20% pullbacks or more in the markets. So, yeah, the odds have increased that we are going to go into recession. But it doesn't mean it has to be a collapse. What we had in 2008 and 9 for our listeners, we just need to be reminded sometimes that that was a depression. That was a financial collapse of the monetary system globally. Really a different situation. But I certainly understand when you're in the middle of this battle right now and the bombs are dropping, as I always say, and the smoke's billowing out, right. It's hard to see the direction of this war. But there is a direction. It's forward, and we'll get through it. But right now, we're going to have some more pain before we get to pleasure down the road.
Okay, well, what does that mean for those of us who have investments in the stocks and bonds markets? What do you recommend for us?
Well, you know, as we've talked to our listeners before, and certainly our clients know this, you've got to up the quality of your investments. Don't go with the high growth and earnings down the road type companies. You want to go with high quality. Boring is exciting right now. Dividends, companies have share buybacks that have solid balance sheets, cash flows, good diversified portfolios. It's not about being in or out of the market. You got to be diversified in the market. and your portfolio has to reflect where you're at this point in your life. If you're pre-retiree, if you're retired, have more cash on the sideline. Certainly have high quality investments. If you're younger and you got time, and we're talking 5, 10, 20, 30, 40 plus years, we'll get through this. We'll ride through this as we usually do. 15 months on average is a recession. And we'll get through this. We just got to ride it out. And I think the market is presenting opportunities. But again, I would tell everyone, focus on high quality stocks, companies, bonds, if you might, investments, if you might, that have gone on sale. I just would not use this market to take on any unnecessary risk with low quality investments.
All right. Well, thank you so much for that advice. And thank you to our viewers for joining us today. We are happy to be back on schedule with our weekly wrap up. So we'll be looking forward to seeing you again next week. And hopefully we'll have some more exciting news to report then, some better news to report then. In the meantime, have a great week and we'll check you out next week. Bye-bye.
Take care.